This is a demonstration of problem 22-3B, Comprehensive Accounting Change and Error Analysis Problem. Royal Palm Inc. was organized in late 2017 to manufacture and sell personal watercraft. At the end of its third year of operation, the company has been fairly successful as indicated by the following reported net income. The problem gives us the amount of net income for 2018, 19, and 20, indicates that in 19 that includes an unusual loss of 45,000, and the 2020 net income includes a $26,000 increase because of a change in the bad debt experience rate. In March 2021, the company has decided to expand operations and has applied for a sizable bank loan. The bank officer has indicated that the records should be audited and presented in comparative statements to facilitate analysis by the bank. Royal Palm therefore has hired an auditing firm and provided the following additional information. So the information that has been provided to us indicates that first, in early 2021, Royal Inc. changed its accounting estimate from 2.5% to 1.8% on the amount of bad debt expense to be charged operations. Bad debt expense for 2020, if a 1.8% rate had been used, would have been $26,000 less. The company therefore restated its net income for 2020. The auditor also discovered that the company had changed its method of inventory pricing from LIFO to FIFO in 2021, and they have shown us the income statements for the previous years as follows. First, showing what it was reported in 18, 19, and 20 on the LIFO basis, and then on the FIFO basis and what the change in net income would have been. In 2021, the auditor discovered that A, the company incorrectly understated its ending inventory by $12,000 in 2017, and they had a dispute that developed in 2018 with the IRS over the deductibility of certain expenses, and in 2018 the company was not permitted these deductions, but a tax settlement was reached in 2021 that allowed those expenses. So as a result of the court's finding, tax expenses in 2021 were reduced by $31,000. So the instructions state in Part A to first indicate how each of these changes or corrections should be handled in the accounting records, and in B to present comparative income statements for the years 2018 to 2020, starting with income before the unusual loss. So I'm going to go ahead and start on the comparative statements, and then we will go through on each one of these different situations and discuss how they should be handled. So we're going to start in this spreadsheet with the income, original income, before the unusual item. So $230,000 was 2018. If we add back the unusual loss of 45,000, we would have $250,000 for 2019, and then 240,000 would be the correct amount for 2020 to start with. Then we're going to start with number one and talk about the bad debt expense. So it states that in early 2021, Royal Palm decided to change its estimate for bad debt expense from what it had been using, 2.5%, to 1.8%. And so they decided to retrospectively use the 1.8% for 2020. And of course, we know that when we change an estimate, we do not use any type of retrospective treatment. They should have just left the bad debt expense for 2020 at the original percent. So we know that they had included a $26,000 increase in bad debt expense in the income that they had reported for 2020 of $240,000. So we need to subtract that amount to take it back to the original amount at 2.5%. because they made it less at 1.8%. The next item is the change in the method of inventory pricing from LIFO to FIFO in 2021. So we know that when we make a change in accounting principle from one inventory pricing method to another, that does require us to use retrospective treatment. So our net income that we see here is what was originally reported using LIFO. But we know that if we had used FIFO, the net income would have been higher in each of those 3 years. So to report it correctly using retrospective treatment, we would have to increase net income for each of these years by the difference, the $10,000 in 18, $20,000 in 19, and $15,000 in 2020. The next thing, the auditor discovered an error had been made in 2017 in the ending inventory. It had been incorrectly understated by $12,000. We know that when we understate ending inventory in one year, that we understate beginning inventory in the following year. So that means that even though we are not reporting anything for 17, we are reporting the income for 18, and beginning inventory then would have been understated by $12,000. So when we understate beginning inventory, we overstate net income. So that means the $230,000 has an error in it for 18, so we need to subtract that $12,000 for that error in the beginning inventory. The next item it states is in B that a dispute had occurred with the IRS over some expenses that had been deducted, and the IRS disallowed those expenses. But then in 2021, they were allowed the expenses. So the question is, do we go back and restate 2018 to show that decision? And actually, we don't. The way that the company handled it, they reduced their tax expenses in 2021, and that's correct. So that's considered to be a change in estimate that would be treated prospectively. So there's no correction made for that for 18. So we have discussed all of the information that the problem gave us. We have recorded in each situation what the correction would be, and the spreadsheet has been calculating the correct income before the unusual item, and that's at the top also. So now we will just record that unusual loss for 2019, and that will give us the correct net income for 18, 19, and 20. And that is the conclusion of the demonstration for problem 22, 3B.